That was what we just explained. It was understandable. Okay, true. No, that was liquidity. Okay, let me restructure it. But yeah, like, so you don't always have to be taking advantage of the liquidity, right? But you have to understand what part of the cycle you're in. So there's three stages chat. There's liquidity, there's breakout. So you know what? Let me just take my time explaining this. We have nothing to do for the next 5 minutes anyways. So you have liquidity. So let's just say this is the range you're in. Okay, this is your resistance, this is your support. If you have a range, you would need to wait for liquidity. So the first cycle is waiting for that liquidity, wherever that is. Let's say it pushes up, breaks the highs, and then closes below the range. Okay, cool. That is your liquidity, right? You can say, okay, cool, that's your liquidity, and you can take the move down because you have direction now. The second wave, I'll say is, or not second wave, but another part of the cycle is the range. So the range is just this. So let me go ahead and divide this up. Draw this over here. Boom, boom. So this is the range. Everyone knows what a range is, so I don't gotta go too far into this. But a range is just when you have a support resistance being formed, and you're just in the range. You're not really moving. The ranges are tradable, but you need plays within the range that you need to develop, which we took yesterday. That was a perfect example. So this is a range, obviously, right? Just a range, simple. The next part of the cycle is gonna be continuation. So continuation is what everyone loves. Continuation is gold the last 3 weeks, basically. When you just move within the ranges. So let's say like this is what's happening. Boom. You're just constantly moving, right? When you can identify what part of the cycle you're in, you will understand what needs to happen or occur next, because it's the same cycle. It's direction first, it's range, it's liquidity, and then direction, range, liquidity, direction, range, liquidity. So DRL, okay? We're gonna use that now from now on. DRL. If you can understand DRL, you will understand price very well, because DRL gives you or puts you in the situation to understand what needs to occur next, right? So DRL. So this is D. I should have done it in order, but this is D, this is R, this is L, okay? Drive range liquidity, or directional range liquidity, okay? So whenever you have a range, or whenever you have the direction here, you would print a range next, because at some point price is going to slow down. When price slows down, this is how it looks. So let's say this is direction, boom, 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 you move, great. Next thing you know, you have a resistance form now, cool. You have a bearish candle closure at resistance, okay? Price will likely start to slow down. When it slows down, it's going to print a range. So let's say the range it prints is from here, right? Boom, that's your range now. You now have a new resistance up here and a new support down here. This is the range that you're currently in. And you can say, cool, what's the next step after range? The range fill, right? So the range basically is the range is going to continue. So therefore, you can take advantage of onion plays. You can take advantage of fake outs back into the range on a smaller time frame. But this is likely what's going to happen or occur, right? After a range, you will get liquidity. So let's say you just do this. Let's say you're just in a range like this. Let's say you're just in a range like this now, right? This is the range you're in. Going back to this example. Once you have a range, you would need liquidity. So liquidity is basically just breaking the highs or breaking the lows in short form, right? That's all that really is. But where and how is what you're trying to figure out, right? So I can't really show it here because there's no price here. I can only use why I drew out. But typically, let's say the bias you had in the direction you had prior to this move, it was a bullish push. So let's just say it looks like this, right? When you have a bullish push, more times you will grab liquidity down to drive up in order to continue the ranges, right? Sometimes it might reverse, but even before it reverses, and this is when I always say, chat, before price drives in the direction, it has to tap this range first. That's why yesterday we mentioned 2160, right? 2160 is very key because that was the topic everyone wanted to see. Before price drives in the direction, it's got to form liquidity. That liquidity grab, it could be anywhere, right? But yesterday was 2160. In this case, let's say we have a bullish directional trend here. Great, amazing. What would occur next is likely a bottom wick like this, breaking the lows, and then continuation. The bottom wick, why? You have a bearish candle here, so price can just drive down easily, right? But since it's respecting the support, any given point, it can just respect and drive and hold. So therefore, you might see come down, close back above. Cool. If you see this on the 1 hour time frame and on the 15 you have a fake out, you know what to do. You can take advantage of this pull up to fill the range, or take advantage of the breakout if you don't want to take the range. Amazing. That's how you trade the ranges, right? The next step is the next step was liquidity and then the breakout. That was it. That was it. Those are the 3 steps. Direction, range, liquidity. And if you can understand those cycles, you would understand what would need to occur next. So in this case here, right, going back to today's example, on gold currently right now, what are we in? We're in a range. So that's why you won't see direction, because look at the 4 hour time frame. Like, this is the range we're in right now. This is the resistance up here on price, right? This is the resistance and this is the support. If this is the range you're in, you're not going to break out until you grab liquidity. 9 times out of 10 it grabs liquidity. It may not sometimes, right? But you got to start with step 1. Step 1 is understanding how to identify them, and you can get better over time to a point where you can identify when you can look for liquidity, when you cannot look for liquidity. But when you're starting off, when you're still new to the concepts, just do things one at a time. Take things year by year, right? Last year we spent time looking for liquidity. This year we spent time understanding how to adapt to liquidity. So over the last 3 or 4 months, I've been talking about how, okay, chat, there's no top wicks here. We got to learn to adapt, right? I think 2 weeks ago on a Thursday or Friday, there's plenty of trades between Thursday, Friday, and Monday where we had no top wicks and we still took the trades down because we had to adapt to no liquidity, right? So it doesn't always form, but again, you have to start with step 1. So in this case here, to keep things short and simple, this is the range we're in between 21.62 and 21.46, right? So in order for price to drive in terms of direction next, because whatever hit in this range isn't direction, it's just range. But in order for price to like do something like this, where it breaks out and drives up, or oh my bad, it breaks. Fuck, I fucked up. So in order for price to do something like this, where it breaks up and drives up like this, right? That's direction. Or it breaks down to drive down like this, you will likely need wicks first. So in this case here, if you can get a top wick over here, tapping a minimum area of 21.62, and you close back into the range, great. You can take the moves below 21.44 because then you have direction, or you can take it to the move on the flip coming down, right? But you don't have to always predict where this is. You can just take this. It's fine. You can just take the range fill because it's the very start of the move anyways, right? Or you can wait for, again, if you were to drive up, you need to wait for a bottom wick. So in this case here, if you print something like this today, where you come down, create a bottom wick at 21.38, 21.36, cool. You close back above 21.62, you know where it's headed next. You can look for positions on, again, this closure over here, or this breakout above here instead, whatever you want to take it, but at least you have direction to plan out your next moves to take. All right, so that also forces you to understand when to hunt and when not to hunt for trades as well, because when you can identify what part of a cycle you're in, you can identify what needs to be printed in that cycle to drive, so therefore you know when to stay out and you know when to hunt. Simple, straightforward, right? So look, like this is the 4 hour closure right now. What would first glance, what would you expect would happen? Like 8 times out of 10, what could likely happen is you get a top wick on the 4 hour candle to drive down a further range. We understand right now that we're not going to break out before FOMC. High chance we won't. There's a slight chance we could, but we're taking a high chance, right? So if price comes up, prints a top wick on the previous 4 hour candle high, flips bearish, I understand that we're not going to break out because we're going to range between 60 and 46. I can just take the sells down towards 21.46 instead and trade the range, because that is my top wick for us to rip down. And that's it. That'll be the move that we'll be looking for, right? And if price doesn't print a top wick, that's fine as well. We'll wait for a closure below 21.50. But there is no top wick here, so we might gotta wait for a top wick here instead of 21.56. Make sense? But that's how you shit. What was it again, chat? DLR. That's how you trade. That's how you identify DLR. Drive range liquidity, or DRL. Okay, that's that, man. And you guys know what DRL is. Like, everyone knows what that is. Even if you didn't come to the stream, you know what that is, because that's also market structure. You guys want to get crazy? We can get crazy. Look, this is what this is, right? This is structure. This is higher highs. Okay, let me make it blue because we're on bullish side here. So higher highs, higher lows, higher highs, higher lows, higher highs. This is market structure. Chat. Chat, you guys know what this is, bro. Trust me. Look, this is your resistance right here, right? Cool. This is your support right here. You might not see it when you have lines like this. Obviously, there's no candles being printed, but what you likely will see, if you can just simply focus on the first 3 arrows right now, just focus on these 3. This is what? A drive. This is what? A range. This could be what? Liquidity, right? You also don't have wicks here, but if this were to be printed on in terms of candles, this is what you'll see. You'll see pushes up, right? Range fill, cool. You then will get like a bearish candle resistance like this. Okay, cool. Next step is a range. So now you have what? Yellow means drive, or let's do blue means drive. Red or range means yellow. So this is the range. Next step is liquidity. Let's make it pink. Okay, so if you were to rip up to continue up in terms of market structure and print a new higher high before doing so, you print a higher low. Higher low, this is what you'll likely see. Price close what? Respecting support. Since you reset the support, close bearish, you can come down, create a bottom wick. But since you respect it, you can flip at any given point. So that's your lower low. There go. That is your liquidity, right? So this is your liquidity now. And then anything above this level will be a continuation of range and direction. Right, so you guys know what all this is. It's all just market structure at the end of the day. It's all just pretty straightforward and simple. So it's just about identifying that within candles that people don't teach you. But when you can identify that within candles, it goes hand in hand, right? But yeah, that's what that is. And then obviously, the rest of the move would be something like this, likely, where you get bearish candles like this coming down, range, whatever, right? And then obviously continuation, and then cool, that's the move. Right, that's it. And then if price were to break back into the range, that's a break of structure, because what do you have now? You then would have lower low, lower high, lower low, lower high, lower low. So when you have that, what happens? You have basically a bearish candle coming down, right, like this, back into the range, right? Closure back into the range, which means that you're breaking back into this range. So you can also take that as well, and you can also say, cool, if this is what's happening, where you have this, higher highs, higher lows, oh, my mouse dead. Fuck, my mouse dead. If you drawing candles too fast, bro, my mouse dead. If you have this right here, chat, where you have higher highs, higher lows, higher highs, higher lows, and then, lower lows, lower highs, lower lows, lower highs, lower lows. Now, all that this really is on a different time frame. Going back to when I say it comes back full circle, is just liquidity being grabbed. That's all that really is in terms of the higher time frame. So if this were to be like, let's say for instance, the 1 hour time frame, right? On the 4 hour time frame, what you're gonna see is you're gonna see something like this occur likely. You can probably establish this as one entire range here and say the break of the highs here was a liquidity grab, and you can say, cool, as you're breaking back into the range now, you are likely gonna continue to push down because you have that top wick that you wanted, right? And that's your move down now. But that's just another way of reading structure. It's all the same concepts, all the same shit. It's just being able to identify them on different scales and different time frames of different candle closures, right? But look at that. 4 hour count is creating a top wick, chat. So if you can grab a